Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of May. Before we talk about May, we really should talk about April. We saw the S&P 500 down 8.8%, a huge drop. Now, on average over the long term, April tends to be one of the better months of the year on a seasonal basis. So what does that mean for the markets? We'll talk a little bit about that later on. We'll also take a look at whether some of the sectors that tend to do well at this time of the year and where the market is right now as well. So let's jump right in and take a look at the S&P 500 from a technical basis to start with. Here we can see the S&P 500 is tracing out a head and shoulders pattern. It's often thought to be a bearish pattern for the market. It doesn't necessarily mean the stock market is going to correct substantially down, but it does have negative tendencies for the market. Here's the left shoulder that took place in mid-2021, and the head took place at the end of 2021 into 2022, and the right shoulder took place in March of 2022. And you can see here the head is higher than the high of the head is higher than the high of the right shoulder, and this is the neckline or the support line, and it's around 4,200 approximately, and we're actually just a little bit below 4,200. And if we end up going down below this level and staying down there for a few days, that's actually quite bearish overall. Now, there's some big exogenous factors taking place here. For instance, the Federal Reserve meeting that could move this market one way or the other substantially from this. But if we do hang around below this support line here, or what we could say is the neckline, for our head and shoulders pattern, that it does indicate from a technical perspective bearish tendencies for the market overall. If we take a look at what's happening from the sector perspective, well, let's take a look at the overall market and the seasonal trends as well here. I'm going to use the Thackeray's 2022 Investors Guide, and let's take a look at the S&P 500's tendency here. You can see here that from 1950 to 2021, the S&P 500, usually the first few days in May tends to be fairly strong, and then we find it fairly weak until the last bit of May, and with a little bit of a rally taking place. Now, I will say this is where the Federal Reserve has its meeting on May 4th, so we could see anything take place from here, and that's really going to influence the market, at least in the short term from there. If we take a look at the market from a sector perspective, I want to show you that the consumer staples sector tends to perform very well in the month of May. And it's on average from 1990 to 2021, it's been the top performing major sector. This column here, this middle column, represents the average gain for that sector, and the last column represents the frequency of outperforming the S&P 500. And let's just take a quick look at the the consumer staples sector. And if we take a look here, we can see that in this case here, the consumer staples sector really has been outperforming from late 2021. It did have a little bit of a pullback there, and recently in April, it performed extremely well against the S&P 500. And we can see here, and this is relative to the S&P 500, we're pulling back a little bit at this level here. And we just came off an all-time high for the consumer staples sector here. So a lot of investors have been coming into the consumer staples sector even though interest rates have been rising. And that's largely because investors have not been comfortable with growth stocks, and they're looking for somewhere to go, and bonds have not been attractive because yields have been going up. And so their default has been some of the defensive sectors, including the consumer staples sector. If we go back and take a look at, in this case here, the next sector on the list here is the healthcare sector, which is another defensive sector. And what you find is typically these sectors tend to be stronger sectors at this time of the year because this is the transition where you go from the weaker 6 months of the year, the stronger 6 months of the year, which hasn't been the case recently, and into the weaker 6 months of the year. And so you typically find the defensive sectors, a few of them actually provide a good value here on a seasonal basis. And if we actually take a look at the healthcare sector here, let's go back over here. You can see here on an absolute basis, we've been really just forming this consolidation pattern from late 2021, but relative to the market, the sector's actually been outperforming the S&P 500. Now, we saw that big, huge jump take place at the beginning of April, and we've seen a consolidation take place recently. And the sector's just starting its strong seasonal period at this point. And I'm going to talk a little bit about biotech in a minute, because the biotech sector is part of the healthcare sector, and it tends to perform well in June and sometimes in May. So we might be able to see a bit of a boost to the healthcare sector based upon the biotech sector as well. If we take a look at the next sector here, which would be information technology. Now, you say information technology, it's not in a strong seasonal period as far as a multi-month period goes. But if we do see interest rates move down and at the same time, investors move to a risk-on mode, we could see the information technology sector actually perform extremely well. So we might see this rally, and that's really what this is indicating. Although it's not not the top in the top two, but it's right up there at the top. So we could see under the right circumstances, with falling interest rates and risk-on mode, we might see investors really come back, buy the dip in the sector, so to speak, and push higher on that. I also want to point out, if we go down here, this sector here, at the bottom of the list, is the energy sector. The energy sector has been on fire since early 2022 and outperforming the S&P 500. There's been some geopolitical a situation where the Russia-Ukraine war, which has had a huge influence on this sector as well. But I do want to point out, despite some stronger fundamentals for the sector, there's always a reason to be in or to be out of the sector. But I do want to say that on a seasonal basis, the energy sector does tend to peak and finish its strong seasonal period in mid-May, and we're getting close to that, and we tend to see it actually pull back. So it's only from 1990 to 2021, in the month of May, the whole month of May, it's only outperformed the S&P 500 34% of the time. It may be that this is another time because we have seen some strong momentum in the sector, but it's important to point that out. If we do take a look at the seasonal period for the energy sector here, let me just flip back over here. Here, in this case, I'm using XLE in the U.S. Relative to the S&P 500. Look at this strong performance. It has been actually consolidating a little bit here relative to the S&P 500 as well. So something to watch out for. The sector may keep going on strong momentum, but it is finishing its strong seasonal period, so we might actually see it roll over as well. If we go back and take a look at this list, I want to take a look at some of the subsectors of the market. This is the one I want to take a look at here, is the biotech sector. Look at the biotech sector. On average in this time period from 1993 to 2021, it's outperformed the S&P 500 66% of the time and produced an average gain of 1.8%. Now, the strong seasonal period for the biotech sector actually starts in June. And July is the best month of the year for the biotech sector. What this is saying is sometimes we can see the biotech sector start its strong seasonal period early. And this might be the case this time around. And I want to take a look and show you where the biotech sector is right now on this. In this case, I'm using IBB for the biotech sector. And look at this, and this is relative to the S&P 500. From May of 2020, the sector has underperformed the S&P 500. But I want to point out that even in here, so if last year as the sector was going down, in a strong seasonal period, in this case from June 23rd into mid-September, you can see here that it actually outperformed the S&P 500, and once it finished its strong seasonal period, it continued down lower, and that's exactly what we've seen. We've seen this continuation down lower and a consolidation relative to the S&P 500 a little bit. So this is actually setting up quite nicely coming into a strong seasonal period, and we have seen the biotech sector start before its June 23rd seasonal period. We have seen in the last few years, sometimes the sector starting in May. So this is definitely a sector to be watching out for. It is oversold on a full stochastic oscillator basis and almost oversold on a relative strength index basis as well. If we go back and take a look at the something else I want to take a look at on the list here, agriculture sector tends to perform well. I want to go down to in this case, gold, okay? I want to talk about gold because it's been in the news. It's actually, we'll take a look at the performance of gold because it's had some real strong headwinds recently of rising interest rates and a rising U.S. dollar, a rapidly rising U.S. dollar. And really gold, I mean, it's had a little bit of a pullback here, but overall it's actually performed okay. Now, its next seasonal period of strength starts on July the 12th. So we're still a little ways out that window, and we can see a lot of volatility for gold in June. And sometimes that presents a good entry opportunity. But and sometimes it's actually it's possible to actually see gold actually start earlier, maybe under the right circumstances. It's strong seasonal rally even in May. And let's take a look. So here's gold. Let me just pull this up for you and go back. Here's gold on an absolute basis. what we've seen is a little bit of a uptick here, consolidation, and just recently it has succumbed to rising interest rates and a rising U.S. dollar. And but relative to the S&P 500, in the month of April, it actually outperformed. So gold was still doing okay relative to the S&P 500. I know that you may say, well, 8.8% negative in April for the S&P 500 is not a good benchmark, but there was a lot of headwinds. We saw the yield on the 10-year Treasury note climb up to close to 3% in April, and we saw the U.S. dollar gain rapid strength against most currencies around the world. And nevertheless, it still did okay. And so we may see gold actually perform quite well coming up shortly. And if we do see interest rates head lower, that would be a benefit for gold as well. So I want to shift gears here a little bit. I want to talk about the midterm election effect. Right now, we're in a midterm election. It's for the U.S. is going to take place in early November. It hasn't been on anybody's radar. Typically, at this time of the year, people are talking about the midterm elections, but that has not been the case. We've seen the media really focus on the Russia-Ukraine war. It's a tragic situation, and other things as well. And the midterm elections really have just been pushed aside. But typically what you find for the midterm elections, and then here we're looking at this dark line here, is the market tends to peak in mid-April, tends to decline into the summer months, flat, and then up in October as we get into the election. And why does that take place? And it's all to do with uncertainty. Investors don't like uncertainty, and they typically will pull back on risk when there's some uncertainty. And typically, when the midterm elections are being talked about around this time of the year, that helps to pull some of the risk off of the market. But with investors really not talking about that, it's being pushed aside. So this effect may actually be delayed. And once the midterm elections start to come into the news, and we may actually see the market head lower from that effect itself. Now, why does the stock market tend to consolidate and then move up in October? Typically, by the time you reach October, all the negativity is baked into the price. Investors are comfortable with the outcome either way, and then the stock market then anticipates the election, and from there, and the market moves higher. That's on average. Now, this year, of course, could be different, but my point here is that right now, there's been no talk about midterm elections, really, and we could be seeing that coming up. And if it does, it typically has a negative impact on the market. It's just another factor that could push the market around, at least to the downside. So where do we stand in the month of May? Well, it's going to be an interesting month. It tends to be the transition month in between the favorable 6-month period for stocks, which runs from October 28th until May the 5th, into the unfavorable 6-month period, which lasts from May 6th until October 27th. Now, the favorable 6-month period tends to outperform the next 6 months on average over the long term. And it doesn't mean that we can't see positive returns over the next 6 months. In fact, on average, the stock market is higher on a percentage basis. It's over 50% from 1950 of being positive. But the profile of those returns is that we tend to see large drops in the market and very few large gains. Now, the large gains, when they do happen, tend to be occur when the economy is moving out of a recession, which is not the case right now. We may be moving into one, but we're not moving out of one at this time. So we don't have that profile for large gains here. And investors really have been getting really cautious recently. And so we've seen some really cautionary signals being broadcast. The defensive sectors have been performing well really since the start of the year and outperforming the market, more importantly. And that's typically not the case. And that's really been because investors have been saying, I don't want to be in growth. I can't go into bonds. I'm not sure about the cyclicals because the economy is slowing down. Where do I go? And so they've been going into the defensive sectors and they've been outperforming. And that's just their default. They still want to stay invested, but they just say, well, I'm going to go hide here. And that's what they've done. Another signal that we've seen is April tends to be a strong month of the year for the market, and it wasn't. Now, when that happens, when you see a month that tends to be really strong, or one of the top performing months, and it just plays out to the downside like it has, it's telling you that investors are really quite nervous about the overall market. Now, we do have the Federal Reserve meeting coming up on May the 4th, and it's going to be probably a binary move for the market, either risk on or risk off, depending on how investors interpret the Federal Reserve decision. whether it's more hawkish than they expected or more dovish than they expected. And the Federal Reserve is trying to come across as a tough guy in fighting inflation. It's expected that they're going to raise the federal funds rate by 50 basis points. And if they really want to get serious on inflation and convince people that they're going to fight inflation and get the most bang for the buck, Powell after the meeting would come out and really use some tough language and talk about really buckling down and fighting inflation. But we'll have to see. We just don't know how that's going to play out. And we've seen a lot of volatility in the markets leading up to the Federal Reserve meeting. But May tends to be this transition month where we're going from the favorable 6-month period into the unfavorable 6-month period. And investors typically like to be in some of the defensive sectors of the market. Now, based upon the Federal Reserve meeting, we could see things change a bit, at least in the short term. And over the next 6 months, there are lots of opportunities in different sectors, and we've talked about a few of them today here that could be starting up shortly as well. But overall, this is the time period where investors tend to be more defensive in the markets. Now, I want to say that we've been in this strong bull rally really since 2009, and it's been really spectacular. And in the summer months, over that time period, a lot of the Federal Reserve stimulus programs have been announced in the summer months, really juicing the market higher. So we've seen this artificial manipulation of the sell in May phenomenon going against that and really trying to push the markets up in the summertime. And I'm not so sure that's going to happen this time around because the Federal Reserve is on a tightening cycle. They're trying to show themselves being tough, fighting inflation. So the markets don't have the Fed on their side from a seasonal basis like they have in the past, where most of the announcements for QE have been made in the summer months, and that's probably not going to happen this year. So we're probably going to see more of that typical seasonal pattern where we see weaker markets in the summer months coming up. And we'll have to come back and take a look at next month and see where we stand, particularly after this the first Fed meeting at the beginning of May here. Thank you very much for joining me today.